Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 2 of my 10-part video series on tax planning for the year-end 2024. As mentioned in video number 1, starting January the 15th, 2025, and running through April the 15th, 2025, I will be hosting a 2024 tax return preparation class. If you would like to sign up for that, you can use the link in the description below this video. Alright, so this particular video number 2 in the 2024 tax planning series is going to be about calculating our future RMDs. This is the second step in our 2024 tax planning now that we have finished projecting our base case 2024 taxable income in video number 1. Now, why would we want to calculate our future RMDs? Well, I would recommend that you consider thinking about tax planning as a lifetime concept. For example, which one of these two scenarios below is better? In scenario number 1, for years 1 through 10, you figure out a strategy on how to save $2,000 per year in taxes. But you figure out that strategy based on your income and financial situation in years 1 through 10 alone, and you ignore years 11 through 20 with this particular strategy. So in this case, we have 10 years times $2,000 in tax savings is a grand total tax savings of $20,000. Now, in years 11 through 20, because you didn't consider future RMDs in your tax planning for years 1 through 10, you will end up paying an additional $4,000 in taxes each year. So that's 10 years times $4,000 per year equals total extra tax paid of $40,000. So in this scenario number 1, the lifetime extra tax paid would be the $40,000 extra tax, which was paid up here in years 11 through 20, less the $20,000 of tax savings that was calculated over here for years 1 through 10, just considering years 1 through 10 in isolation, and that results in $20,000 of extra lifetime tax paid for scenario 1. Now, alternatively, in scenario number 2, for years 1 through 10, you adjust your strategy such that your tax savings is only $500 per year instead of the $2,000 per year that we saw in scenario 1. In other words, you are willing to absorb an additional $1,500 of tax per year under this revised strategy. And you make that adjustment that we just discussed above due to considering the impact it has on years 11 through 20. So in this case, we have $500 times 10 years is a total tax savings of $5,000. Now, in years 11 through 20, because you considered future RMDs in your tax planning during the first 10 years of the scenario, the result will be that you only pay an additional $1,500 in taxes each year for years 11 through 20. So that's an extra $1,500 in taxes paid per year times 10 years is total extra tax paid of $15,000. So in scenario number 2, lifetime extra tax paid equals $15,000 extra tax paid, as was redetermined over here for years 11 through 20, less the $5,000 of tax savings that was obtained as redetermined for years 1 through 10, equals $10,000 extra lifetime tax paid. So again, scenario 1 was $20,000 extra lifetime tax paid, and scenario number 2 was $10,000 extra lifetime tax paid. And so which one of these two scenarios is better? Well, you know what I'm going to say if you've been following me on the channel. Neither one is better. It's only better based on what you want, based on your facts and circumstances. Scenario number 1 could allow allow you to pay less tax now and have greater positive cash flow now in exchange for a greater lifetime tax burden and a higher lifetime effective tax rate. On the other hand, scenario number 2 could allow you to pay more tax now and thus have a lower positive cash flow now, but in exchange for a lower overall lifetime tax burden and a lower overall lifetime effective tax rate. And by the way, what major tax strategy is based on the concept of paying more tax now in exchange for an overall lower lifetime tax burden and lifetime effective tax rate? And the answer is, of course, Roth IRA conversions. And so the first step in deciding what tax strategy or combination of tax strategies is right for you is to lay out the numbers, calculate the options, and figure out which combination is right for you. With that, let's go to the personal tax planning template. Alright, so we're in the personal tax planning template. We're going to be on the Roth conversion tax strategy tab right here. This is the tab where we're going to calculate our future RMDs. Now, first things first, remember that when you download the personal tax planning template, if you are married filing joint, if there are 2 spouses in the situation, IRAs are tracked and treated and dealt with separately by spouse, even if you file a joint tax return. So the very first thing you're going to do is just make a duplicate of this tab right here so you have one for each spouse. And then if I go over to the Personal Tax Planning Template main tab, you will see that the RMDs for spouse number 1 are linked to one line, and the RMDs for spouse number 2 will be linked to another line in the same fashion. Okay, the next step is to go here to the IRA entry tab, and again, we will have one tab for each spouse, and you're going to update this right here with whatever accounts you may have for traditional IRAs and whatever the balance was at the end of the previous year. So if you're doing 2024 year-end tax planning, the most recent year-end will be 2023. If you're doing 2025 tax planning, then you would enter the balances as of the end of 2024. Since 2024 is not over yet as of the making of this video, we don't have the actual balances that would go right here yet. So we're going to start with what we have, and that's the ending balances as of 2023. Now, the total of all your accounts, in this case, we're going to have $3 million approximately. That is going to carry back over here to the Roth Conversion Tax Strategy tab. It'll be in this row right here, 2023. And if I scroll over a bit, it'll be right here. There's the $3,019,320 in the 12/31 year-end account value section. So this is going to be the starting point for the projected calculation of our future RMDs, this number right here, or whatever the equivalent number is in your situation, obviously. Okay, so the next thing that happens is this value right here, which is the ending value for 2023. That will carry right here and become the beginning value for 2024. Then the next thing is that we are going to see how good your projection skills are for your investment accounts, specifically your IRAs. You need to figure out what your estimated rate of return is on your total IRA portfolios. Remember that we added all of them up together, and you need to put that rate of return right here. Now, I have 2 options here. We can either apply a rate of return right here to all years, or we can enter them individually. My recommendation is to pick an average expected growth rate for your investment objectives, your risk tolerance, and so on, and have that rate apply to all future years, for example, starting in 2025 and beyond, because it's going to be much harder to project with precision for 2025 and future years. But for 2024, since the year is almost over, you should be able to project a growth rate or rate of return that is pretty close to what you're actually expecting to get. So you can change this number right here to 4%, 5%, minus 1%, whatever it actually is expected to be. Let's just go ahead and try that. Assume this was a pretty good year. year in the market, you did well. Let's say you got 6%. So I'm going to change that to 6%, but I'm going to leave everything else linked to the main growth rate up here at 3%. Now, after that, you enter any contributions as a positive number or any distributions that you took, excluding Roth conversions. Just if you happen to have taken a distribution from the IRA or any of the IRAs for whatever reason, you can put those numbers in right here. And then this one right here, if I double click on that, is just going to be the sum of the beginning balance plus the projected growth plus any contributions minus any distributions. And that is going to be our projected value of all the IRA accounts at the end of 2024 before we consider any Roth conversion. Now, for the moment, I'm just going to go over here and I'm going to take out all of these Roth conversions that were in here from a previous example. Your decision making about doing a Roth conversion, I have a complete 8-part video series that goes into specific detail about the Roth conversion decision. If you are new to the channel and have not watched that video series, go to my channel, Number Crunch Nerds, and look for this video right here, number 1 in the series, Roth IRA conversion, how to calculate. It has a 1 right here in the corner. This is the first video in the series, and this will get you started on making your Roth conversion decision before 2024 is over. For this video that we're doing right now, we're going to put aside the Roth conversion decision for the moment, and we're going to focus on this calculation of RMDs. Because in order to make this decision, you have to calculate your RMDs first. So we are doing the first step before we even get to this decision. Okay, now 2 quick things before we get to the calculation of the RMDs. Number 1, somebody asked in one of the comments on the channel, they said, hey, if the Tax Cuts and Jobs Act is expected to be made permanent under the new Trump administration, which I am inclined to agree probably will happen. However, I doubt that it will be made permanent exactly as the law currently exists. I mean, they always like to change things up, right? So there probably will be some things added, some things taken away, some brand new things we've never heard of. They might say, yeah, the Tax Cuts and Jobs Act is being made permanent, but I'm sure it's going to be modified in a bunch of ways anyway. But for purposes of this argument, let's assume that all of the headline tax rates remain the same. So the question that the person asked was, isn't the point of Roth conversions like to convert income now, assuming that tax rates are going to go up in the future, but if they're not going to go up in the future, then what would be the reason to do Roth conversions? And the answer to that question is going to be right here in this column. This right here, your future RMDs, is the big reason why people do Roth conversions. Because all of these numbers, which we're going to get to calculating in a few minutes, all of this represents taxable income that is going to be forced on you. So even if the tax rates remain exactly the same as they are in current years versus future years, you may have a lot more income in future years due to RMDs, which is going to bump you up into higher brackets when you may have room available in lower brackets in the more recent years, particularly within the Roth IRA conversion sweet spot, which generally is somewhere between retirement and when you start taking Social Security and when pensions start and when RMDs start. There's often a lot of room in the lower brackets where you can get some of this income that's going to end up in the higher brackets out of here and bring it back to the more recent years. But the point for this question is that the tax rates can be exactly the same the entire time. So my answer to that is going to be no, that changes in tax rates and law is probably not the primary reason, since even if they do change, they're probably not going to change that much. The big reason is going to be RMDs. And then the second big reason, which people don't like to talk about, but it's going to be another reality that is forced on one of the spouses, is widow's penalty. Remember that in the earlier years, you have the married filing joint brackets, but when when one spouse passes and the other spouse has not only their own IRAs, but the inherited IRAs from the spouse that they took over, now you have basically double the income, so to speak, in the single brackets. And that again has absolutely nothing to do with law changes. The law can be exactly the same the entire time. So what you want to do, if you can, is get as much income out of those IRAs as possible and get it taxed in the married filing joint brackets while you're both alive, as opposed to allowing it to accumulate and then one spouse has to deal with huge numbers in the single brackets after the first spouse passes away. I know people don't like to talk about that, but that's where a lot of your income gets heavily dinged. And so those are the two big reasons that I would say RMDs and widow's penalty are all the reasons you need to get as much income out of RMD territory and into the current year if you can, following all of the strategies that I go over in that Roth IRA conversion video series, with law changes kind of being like in third place in priority. So that addresses the first item that I wanted to talk about. Now, number two, just a few moments ago, I had said we're going to test out your projection skills over here when you determine what a rate of return is that will be appropriately applicable to all of your IRA accounts for 2024. And I never really finished my thought on that, so let me just finish that up real quick. You have your year-end 2023 balance, you have your rate of return, you have your contributions, you have your distributions, you have a number right here as the ending value before considering any Roth conversion. How good of a job are you going to do estimating what this number is before we get to December 31st, 2024? If you're working through the spreadsheet and you're typing in these numbers and you're going through this and you get a number right here, and then you get your statements for all of your IRAs in January of next year and you add them up, and the answer is nothing remotely close to this number right here, what are you doing? Is it too many pina coladas? Is that what's going on? Too much eggnog? All right, I don't know. You have to decide for yourself what the reason is, but if you come up with a number that isn't remotely close to what the actual is going to be, then you need to take a little bit more time to sit down with your finances and make sure that you know what is going on here. Your projection of what this number should be versus the actual, especially now, this video is being made in November of 2024, you should be pretty darn close. And if you are pretty darn close, then I would say that your ability to project is pretty good. If not, you need to take a little more time and a little more effort to try to figure these things out. All right, so that's all I wanted to say right there. Now let's continue walking through this, and then we're going to jump into the calculation of the RMDs. Okay, so now that we have this projected ending balance for 2024 right here, we're putting aside Roth conversion analysis for the moment. This number will become the starting balance for 2025. Then we will apply our rate of return. It will calculate a dollar amount for the growth in the IRA portfolios. You add contributions and distributions, and then you get another ending balance at the end of 2025. And then this process will just repeat until you get to age 73. Now, as many of you are aware, the age for which RMDs will start is going to change from 73 to 75, and that is going to apply to people who were born in 1960 or later. So you can see right up here, I have an entry field for your birth year. Again, this will be by spouse because this particular tab only pertains to one spouse. If you were born in 1959 or earlier, you will see that the RMD calculation will start here at age 73. If you were born in 1960 or later, I'm going to type 1960 into here. You will see that the RMD calculation will then start at age 75. Now I do have a new RMD start date checker right here over on the uniform table tab. This is going to have the years when people are born across the top, and it's going to have the RMD start year right here. And the real years when people might get confused are going to be those people born like between 1958 and 1961, because we have a transition of rules right in here. And so if we scroll down to this section of the chart, which is really the relevant section, and you read any of the language about how the rules change, They always talk about if you turn 72 by a certain year, then RMDs will start at 73 of the subsequent year. And then when the law changes, it says if you turn 74 by a certain year, then you will start your RMDs at 75 of the subsequent year. And so the transition period is right in here. So when you read the language in isolation, it can be quite confusing, especially if you're born in 59, 60, to figure out which rules apply to you. But if you look at this chart while you are reading the rules, you will be able to trace from the year you were born down to your current age and across to the year when the RMDs will start once you turn 73 in the subsequent year, or once you turn 75 in the subsequent year. So I found this chart to be very helpful to figure out which set of rules apply to you depending on what year you were born. And there's also an additional video in the members area talking through this section between 1959 and 1961 in more detail. But the long and short of it is if you put 1960 or later into this cell right here, then the RMD calculation will start here at age 75. Okay, so I switched it back to start at age 73 just for purposes of this example. And so the interpretation of what we are looking at right here is as follows. We're expecting 3.2 million and change to be in our combined IRAs at the end of 2024. We're applying an average rate of return of 3% through the year when we turn 73. We have not yet made any future adjustments for contributions or other distributions that are not Roth IRA conversions, but we certainly could add numbers in here if it was applicable. And so based on that information, at the end of the year that we turn 73, we are expecting a balance of about $4 million in this example. And that's when RMDs are going to begin. The RMD calculation itself is pretty straightforward. If I click on this, it's basically just the previous year's ending balance right over here divided by this RMD factor right there. And that is what will calculate your projected RMD for that year. And the same process will repeat year after year until one of two things happens. Either the IRA balance goes to zero and thus you're done with RMDs if there's nothing left in the traditional IRAs, or you can choose to turn the calculation off after a certain year if you want to test, for example, what balance might pass to your beneficiaries after you reach a certain age. And of course, once they inherit that IRA, they're going to be forced to take RMDs over only 10 years. So if they happen to be high earners, then the inherited IRA RMDs could be taken out at potentially the highest marginal tax rate. So that is yet another reason why if you have room in lower brackets, particularly in the married filing joint brackets, and you're able to get Roth conversions done such that you reduce those RMD balances, you are also reducing the amount of traditional IRA that your beneficiaries may inherit while increasing the amount of Roth IRA that they may inherit, thus reducing the tax burden on them and reducing the overall effective tax rate and tax burden of your family taken as a whole. So as an example, if I just wanted to turn the calculation off, let's say at 89. Okay, you're going to test through 88 and turn the calculation off here. I just type in a no. And that would stop the RMD calculation from occurring, and you could see, okay, this is the balance that could potentially go to my beneficiaries for which they would have to take distributions over 10 years. If you're doing this in conjunction with your beneficiaries and trying to minimize the tax burden of your family taken as a whole. And if you were doing that, let's do a little pop quiz here. If you were working with your beneficiaries, let's say it's your kids, where would this number, 2,737,386, where would this number go on their version of the personal tax planning template? Well, it would go right here on the inherited IRA tab. They would take that 2.7 million and they would drop it into this box right here on their version of the personal tax planning template. they would figure out how old they would be in the year subsequent to the year when you hypothetically passed, which in this example, if you recall, we said you had passed at 89. That was when we shut off the calculation on the other spreadsheet. And once they determine that number, that is when the 10-year period for distributions from the inherited IRA that came from you would begin for them. Okay, so next up, where do these RMD factors come from? Well, if you recall, they come from IRS publication 590B. And the particular factors that we see listed over here will come from the Uniform Lifetime Table, table number 3, which is found in Appendix B of that 590B publication. So you can see right here at age 73, we have 26.5, 25.5, 24.6, and those numbers come from right over here, 26.5, 25.5, 24.6, and so on. Now remember that Table 3 applies to 3 categories of individuals, and this is the most common table to be used. The first group is unmarried owners of IRAs, so if you're a single filer. The second group is married owners of IRAs whose spouses are not more than 10 years younger. And then finally, group number 3, married owners of IRAs whose spouses are not the sole beneficiaries of their IRAs. So generally, most people fall into either categories 1 or 2. They are a single individual, or they're married and both spouses are within 10 years of each other in age. So the Uniform Lifetime Table is going to be the default that is included in the personal tax planning template over here. However, there may be some circumstances where you need to use table number 2, the Joint Life and Last Survivor Expectancy Table. And this will be the case for owners of IRAs whose spouses are more than 10 years younger and are the sole beneficiaries of their IRAs. Now, the use of Table 2 is much less common than the use of Table 3, generally because this circumstance right here where the spouses are more than 10 years difference in age is just less common to see, although it's certainly not impossible. In fact, ironically, as I was making this particular video, I received an email from one of the customers of the Personal Tax Planning Template program, and within the question she indicated that she was 57 and hubby was 68. So there you go. That's an 11-year difference right there. So for that particular individual, if you're watching this video, or for anyone else where your spouse is more than 10 years younger than yourself and the sole beneficiary of your IRA, you are going to be in table number 2. And included in the members area for the Personal Tax Planning Template program, as of right now, is a video that shows you specifically how to convert these table 3 numbers right here into the table 2 numbers that you need through a very simple process. So make sure to watch that video if this situation right here applies to you. Okay, so now that we have the projected RMDs calculated, these numbers will be taken to the face of the personal tax planning template, and they will appear right here in this particular row. So there's the 148,535 when spouse number 1 turned 73 years old, and that comes from this row right here, 73 years old, 148,535. And so once you have your RMDs calculated for spouse 1 and spouse 2, and you have all of your other income items projected for future years, you are then ready to start your Roth IRA conversion analysis. And if you're interested in that, then make sure to check out the 8-part Roth IRA conversion video series that's on YouTube. You can find that by simply searching for Number Crunch Nerds Roth IRA conversions. So that's going to be it for this video number 2 of the 2024 year-end tax planning series. Remember that I will be hosting a 2024 tax return preparation class, which will be held January 15th through April 15th of 2025. If you are interested in that, make sure to sign up at the link in the description below this video on YouTube. So that's going to be it for today. Hope you enjoyed this video, and I'll see you in part 3.